Hi everyone. Thank you so much for joining the How to Manage Your Money in 2020 webinar. My name is Yana Abramova, and I'm a VC at Pretiosum Ventures. It's an early stage venture capital fund in London. And together with me here is one of our portfolio companies, Rosecut Technologies, and its CEO, Qiaojia. Let me just give you a quick background on Qiaojia. She was formerly the co-head of Asia desk at Coutts, which is like the leading wealth management bank. She was awarded PAM. It's a leading association in private banking. She was top 40 under 40 in 2018 for her outstanding services in private banking, and she grew her assets under management from 0 to 100 million pounds within just 3 years. To many people's surprise, she left a fast-track career in banking behind, and now she co-founded Rosecut. So let's find out why. Over to you, Qiaojia.
Thank you, Yana, for a lovely intro. And hi, everyone here. I understand there's a lot of people from the startup community and from the business schools here. A quick words on Rosecut. Rosecut is the financial strategist who help you to answer the big and important questions related to your personal finance and help you to get there. So for today's webinar, we got a lot of questions recently about how to manage your personal finance in 2020. And both Yana and myself decided to put this webinar together so we can go through some of the important points. It will be about an hour. We will spend about 50 minutes talking and 10 minutes Q&A. Now, together with us is David Stoney, who is our marketing and client service manager at Rosecut. So he will be able to help to put your question forward as well. So do not hesitate to put it down as you go along.
Qiaojia, and before we go ahead, I just forgot to mention that I'm actually also a client at Rosecut Technologies because, and then this is actually one of the reasons we decided to put this webinar together. So professionals like me that work in finance, for example, or like technology, they normally so busy and they just don't have time to allocate their capital, or they actually just don't know what to do with their own money. Like Rosecut and Qiaojia was really helpful to me, and I've got as well a lot of questions on how to manage personal finance. So we decided that this webinar would be really, really helpful for everyone, for the whole community. So yeah, let's go ahead.
Thank you, Yana, for coming forward and announcing this publicly. Yes, so today's webinar, we are looking at the following 4 parts. One is that, where we are as a quick intro, and then the typical mistakes people make, especially during volatile times like now. And the third part is how Rosecut can help you. And then we will actually come down to case studies of how you can kickstart your investment and building your financial future. So quickly on the intro, on the highest level, where we are today, as everyone is aware of the COVID health crisis, and which has turned into economic crisis. So, it's pretty scary to look at the headlines of employment rate or the furlough scheme that offered by the government to support the economy. And so, this is the time naturally people would feel less certain about their financial future. And we do expect there are some tough times ahead. But what I would like to say is that this is not the end of the world. Because if you look back to the history, you will see that, in humans' history or in financial histories, there will always be up and downs. It's just unrealistic to expect everything will stay rosy forever. And I'm about to show you how this, has happened before and is happening now and will be happening in the future. And we can do something to tackle that. So here is a chart of, FTSE All Shares year to date. From the sort of February highs to the to the dip in the late March, it was about 35% discount on the value. So you would actually look at that thinking it's pretty scary, because if you had £100 invested at the time, you would be staring at £70 or even less than that in March. So this is why it made it difficult for people to think, should I really be investing, or what am I going to do with this financial market? But I would say our lifetime is much longer than just a year. So if we say, with the current and technology and health conditions, let's use 100 years as your potential lifetime. And this is a chart to show you what the market would have been. And you notice the 2020 is just a small dip relatively compared to what it was before. Now the 2000, where I'm pointing right now, that's the tech bubble when it busted in, and the global financial crisis in 2008. And this is where you see two big downturns. Now, if I ask you, some of you probably have heard of the Black Friday 1987, and you could barely see that on the graph. And that looks like a small dip, was it? But at the time, it was a terrible bear market start, and that's where the market had a sharp correction. Now, this is a linear graph which shows you the sort of absolute value of the market, which goes exponentially over time. And if we replot it with a log scale to show you the percentage of change, and you can see for the past 100 years, there will be always up and downs in relative value. And this is what I would say as a first point. Bears and bulls are all part of life. But luckily, bull markets are typically much longer than bear markets, and we just need to survive that in our lifetime. Maybe 7 times, maybe 10 times, depending on how long each cycle is. On average, it's 5 to 7 years. But the last bull market has been 11 years, from 2009 to this year. So moving on to the typical mistakes we have seen people make when they are panicking, seeing this kind of volatility in the market. The first point is emergency fund. Now, this is the point we talk about it so often, but people don't usually remember it until it's the time they need it. So what is the emergency fund? It is defined as minimum 3 months of your monthly spending, or if you want to be cautious, you can put down 6 months that you put aside. You don't spend it, you don't invest it. It is just cash sitting in your bank account, acting as a cushion and as an insurance for any emergencies, basically. So you would say, okay, I'm not generating return out of that. But the point of the emergency fund is, if you lose your job, you may take a couple of months to find another job and getting back on your feet. Or if you need a major spending, you don't have to fire sell your financial investments or your real estate to get the cash to pay for that. So emergency fund is really important, and some people probably feel it now, post the crisis. And the second point is the other extreme to people not holding emergency fund, which is holding too much cash. Some people have 6-figure cash in the accounts, or people I have seen have close to $1 million because they just feel the comfort of having the cash in the bank account. But what I would say to you is that there is a real cost of holding cash, which is the inflation. The way to look at it is that inflation will always fluctuate, but surely you are losing money out of your cash. You are losing the purchasing power of your cash every single year if it's not generating return for you. So the past, probably the audience today here are too young to experience the double-digit inflation in the 70s. It was between 10 to 25%, 25% in 1975 in the UK. And globally, many countries have experienced double-digit inflation. So what I would say, beyond 3, 6, or even 12 months emergency fund, the rest of the cash needs to be invested.
Qiaojia, can I ask you this question about, the cost of cash, like being, held on your account? Maybe can you give any example about, like, for example, if you have a lot of cash now, I mean, what would be with this cash a couple of, years later? Because this is kind of an astonishing number, right? So, for example, if you invest 1,000 here, like today, and then, the with a percentage of, let's say, 10%, it can grow like significantly.
Yes, so that's a very good question, because, for example, if you have £1,000 in your account and if it's not invested and the inflation rate is, let's say, 5%, which happened in 2008 and 2012 in the UK, then next year, what you can buy with that £1,000 is actually 950. And the year after is 950 times another 95%. So, your purchasing power is diminishing. Now, if you invest into something that's generate return, that will be able to, use to offset the inflation and perhaps a bit more. So, there is, on our platform, which we will show you later, you can actually set the inflation target yourself and to play with the scenarios. For example, the UK central bank sets their inflation target at 2%, but you may think it might be higher. And if you have an international lifestyle, you may think your personal inflation rate is 5%. And typically private banks, by the way, use 5% as to build into their models for the clients, because international travel goes up more than 10% usually every year. So is private education. So it's not just what the central banks think is 2%. I think another question, Yana, one of your contacts asked before, is hyperinflation here, right? Given how much money the central banks have decided to print to support the economy after the COVID crisis, people are worried about whether there's going to be hyperinflation. The quick answer is super unlikely. Hyperinflation is defined as, inflation rate over 50% per month. So this is very difficult to happen in a country, a developed country like UK. You need extreme policy mistakes to get there. So, structurally, and also the demographics and technology improvements and sort of the falling union membership and all that disinflationary in nature. So I don't think we're going to see 50% inflation. So don't worry about that. Moving on to the third point, stick to a single way of making living. I just want to quickly touch upon that because some people are not employed at the moment, or they want to have additional revenue stream. There's so-called slash generation, that you can have multiple titles, multiple professions, multiple revenue string to support yourself. So even if you do have a stable job, there's nothing wrong with exploring alternative way. There are plenty of things that you can do. Even just from your bedroom, you can do online tutoring, you can do online assisting, online copywriting, everything. So I'm not an expert in that, but just want to point it out. The fourth point is about having the budget and adjusting your budget. Without having to go into too much details, there's two key points I would make here. First of all, is that people usually spend from their monthly income and then see if there's any leftover, and then they will invest. The reality is, after you spend it, it's unlikely you can save. So the first thing you should do after you receive your salary or income, you should set aside a certain percentage as your saving, and then go from there. How much you be saving is the second point, would be, totally relate to your personal circumstances. And this is not something you can, one size fits all, and then listen to some arbitrary, you should be saving 10% or 30% or 50%, otherwise you're not doing a good job. And the same thing goes with the, bigger range that's related to your budget. How much you should be spending and saving and investing is something, you should be reviewed and set up on a regular basis, so you know where you are financially. The next point about selling investments when the market is going down. This is a mistake many new investors make because they just can't resist the fear when the market is having a sharp downturn. Now, what I would say to you is that, despite what we saw in March, when you see a quick drop in value, that's always the wrong time to sell, almost always. Because if you invest £1,000 and on paper, you're losing 50% of the value, now it's at 500. But if you sell it, you are crystallizing your loss. And then for you to gain that £500 back, you need 100% gain. And this is much harder than your 50% loss to be, recovered over time. So, you may decide to lose, to change your position at some other time, but as a general rule, you should not try to panic sell your assets during the peak of the crisis.
This is a very interesting point, Qiaojia, because among my friends, among my acquaintances, actually a lot of people started to panicking, even though they are actually, work in finance. I guess it's very difficult to resist and, not to be influenced by this panic around when you're talking about your personal finance.
Totally. I think it's an interesting point, Yana. I think there's a lot of finance professionals actually came to Rosecut in March and trying to go to the market, just like yourself, right? They see this market correction as an opportunity once in a decade time since 2008 to go into the market and pick up a 30% discount. Now, this is how some of the more experienced investors, they see this, differently from the general public. But the people who have their money already invested, they would feel it's difficult to stomach looking at the 30% loss year to date. And so this is a message to them to say, even if you're seeing that, just like myself, my investment was down like 20-30% during that time. It is difficult to deal with, but just remember, you are not judging your investment on an annual basis. You are looking at it from your lifetime basis. And over time, the market would almost always grow because the GDP grows, and that sort of reflects back into the market. Now, we will talk about the detailed projection a little bit more later on. But for now, right? So,
if I mention that, like before we moving ahead, so
sure.
If you have any questions, we will host like a Q&A session after the webinar. So please, just drop us like all your questions that you have in a Q&A window. Thank you.
Cool. So the last point about the biggest mistake is that for people who's not having a diverse portfolio, right? Like we hear about the term diversification all the time, but what does it mean? If you put everything into your home and buying the biggest home possible, then it's not a diverse investment because your home is not your investment. Simply, you're living in there, you're not generating return from that. And if you're thinking, oh, I can sell it for capital gain in the future, well, you still need to live somewhere, right? It means you're downsizing, or, alternatively, you are not optimizing all this cash you put into your home over these years. Similarly, if you put all your spare cash into 3 buy-to-lets in London, that's not a diverse portfolio because they're all tied to London real estate, to UK economy. So, when we are talking about diverse portfolio, it should be meaningful across different asset classes. It should be meaningful in terms of the allocation, whether it's in different countries or different industries. And that's, it needs to be really carefully looked at. Moving on to the next page, next section. So we are talking about taking actions and how to set a winning course for your next phase. Now, given that we have a bit more time at home, and this is really a good time to review your personal finances and to really reflect, what's important to you, and to frankly prioritize. And the first step I would recommend is to find out your net worth. Now, what is net worth? The simple definition is your assets minus your liabilities. If you own a $500,000 home and 400,000 mortgage on that home and nothing else, then your net worth is $500,000 minus 400K and 100,000 in the property. Now, if you spend all your salary every single month and have 20,000 debt on your credit card, then you have a negative net worth of minus 20,000. So the first thing I would say is that, find out your net worth, and we will show you how later on. But also, once you know that, you should aim to clear your bad debt. Bad debt is anything short-term like bridging loan or, a credit card loan or anything that with interest rate above inflation. Given the negative interest rate environment and how it looks like it's going to last a long time. So, if you are paying a really high interest rate on certain debt, certain lending, it's really not worth it. The next point would be, if you're employed, luckily, try to save more.
Qiaojia, can I ask you again, what do you mean by save more? Like, is there any certain percentage from a salary a person needs to allocate for like a saving kind of account, or what would you say?
Yeah, I agree. I think the save more, it sounds quite general and vague. But what I would say is that, how much you should be saving is first of all, is a percentage of your income. Doesn't matter whether it's single income or multiple income, but also the percentage should be based on where you are in your life and, how your circumstances. So for example, if you are in your early 20s and just on your first job and making 30K every year, perhaps saving 10% is good enough. And this 10%, if you invest, you have a much longer time frame, right? Like maybe half a century to generate return. But if you're in your 30s and 6-digit salary, frankly, a lot of the big school people here, then you should be aiming at a higher percentage. Now, if you ask me, should I be saving 30% or 40%? What is the right number for me? My answer is there is no one size fits all. It really depends on where you want to go, right? Like if you want to retire with 5 million in 30 years time versus you want to retire with 2 million in 30 years time, that drives the percentage how you should be saving. And there is a lot of sort of financial modeling behind this, but we have built it into a tool for you to iterate to say, okay, if I want to enjoy financial freedom by the time I'm 50 years old and spend 60,000 a year, that translates to a pile of assets of 3 million I need to hit before I retire. And how much should I be saving on a monthly basis and investing that saving to get me there? Right. Yeah. This used to be a super manual and difficult job to do, but now we can show you that in 10 minutes.
Yeah, look forward.
Yeah. So and also just on that point, I would say for people who have versatile employment, switching from one job to another and switching from one career path to another. There will be a fluctuation in your income. that you just have to adjust it to, you just have to adjust to it, flexibly. So the next point, if you're unemployed or having a big difference in your income, like myself, right? I left my banking job behind, and my current salary, agreed by our investors, is 30% of what I used to earn. So I can't feel entitled to the lifestyle I used to have, and I cut my shopping and cut my travel. That's what it is, right? So if you are unemployed today, you have to minimize the spending and not feel entitled to, okay, I used to lead this lifestyle and I have to continue on that, because that would just eat into your saving and eat into your future. And here comes another point, comes the same point again, create alternative source of income. Plenty of entrepreneurs born out of their kitchen table. Plenty of people find amazing second income sources. So it's just a way of doing that. And either way, budgeting is super important for you to look at your income and your outgoings and how you maintain the right optimal balance to get to where you want to be. So the final point of take action is learn a new and crucial skill, which is build a financial plan for your future. This is crucial because this will drive basically your financial future, regardless of how much money you make. And this is new because most people would have never learned this in school or at work. So if you see, a lot of the audience today, based on my knowledge, come from great education, on amazing career track. And you think, I worked really hard, I deserve a great financial future. Only if I just work hard, I will be able to earn more money, and then I will be able to retire comfortably. Well, that's only half of the picture. Based on my experience in private banking, I can tell you your income doesn't equal your wealth, doesn't equal sustainable financial future. Earning more money is not the solution if you spend it all. You can earn $1 million a year and still have a hand-to-mouth lifestyle driven by your lifestyle inflation, which basically means the more you earn, the more you spend. And when I was at Coutts, we went through trainings about how certain segments are so-called high-risk group, which are celebrities, sports people, and tech entrepreneurs. Many of them, if not most of them, go bankrupt in their 40s or 50s. And this is why you see the news, some of the celebrities go bankrupt. And you would wonder, how did they get there, with millions of income or tens of millions of income? Well, the reason why is because they spend as much as they earn, if not more. So earning more money doesn't solve your financial future. You understand how to build a financial plan.
It's actually a great point that you raised right now, because I wonder, the more you actually earn, the more you need. And it's I think like financial planning is something that is the same as like goal setting for your life. If you know your goal, you definitely will get there, but you really need to kind of have it in mind, at least.
Exactly. Right? You need to have the goal in mind, and also you need to set the right goal. For example, some people would say, I'll save up 100,000 for amazing wedding. And then perfect execution after 3-5 years, you are there. And you spend 100,000 for your perfect wedding, and you wake up the next morning, what's next? Where do I go from here, right? And this is not a sustainable goal. So, in terms of the goal, it's not, there needs to be some guidance on what kind of goals that, people should be setting up. So this comes to the point where I would be answer your question why I left Coutts to build Rosecut, because when you are at the private banking, you look after your clients, you provide the service to them in a labor-intensive way. You have 40 hours a week, and you have to achieve the target of bringing 30 to 50 million pounds of new investment into the bank every year. So what do? You go after bigger and bigger clients with better and more complex skills you build along the way, and pass down the smaller clients to your junior. Now, I've played the game. I played it well, to the point where most of my clients are ultra high, and I ask myself, do I see the meaning of my life is as, looking after 30, 40 maximum wealthiest families? That's it? And I completely feel that's not what my skill set should be for. And I decided to leave private banking because I have this belief. I think the secret sauce of preserving and growing one's wealth should not be reserved for the already rich. It is a really valuable skill set that people could, start to learn at a much younger age, i.e., before they made millions in their 50s or 60s. It could make a huge difference to their life if they start to get on the right track in the 20s, 30s, or even 40s. So we built Rosecut, and Rosecut is here to help you. So we offer bespoke and regulated advice in real time. What does it mean? Bespoke means that the advice is tailored to you. It's not a cookie cutter solution. And regulated means it's actually, we are responsible for the outcome, and we are regulated by the FCA. Now, if private banks can't make the unit economics work with expensive advisor force, we can't either. But this is why we use AI to build it into a software to be able to provide the service to you. So we guide you through your financial journey to the future you want. And we define the future together by a combination of our learning algorithms and human insight. So the next step we want to bring to people's attention is for you to have a successful financial planning. There are things that you should care about, which is your financial vitals, as I call them. It's like you're going to see your doctor, or do your annual health check. They look at your blood sugar, they look at your BMI, all that kind of vitals to see how healthy you are. And these are the things we look at. The first one, as we mentioned before, related to your saving and related to your budget, is your saving rate. And it should be the right saving rate for you. Here I would just quickly mention the FIRE movement, which has been a bit trending recently. FIRE stands for Financial Independence, Retire Early. So it's a maximum saving movement, and people try to save 50%, 70% of their income, so they can quickly accumulate the wealth and retire early. Now, again, I feel things should be reasonable and based on your personal needs, rather than the cookie cutter say, please save 70% of your income, otherwise you're failing. Sometimes you might have to spend some money to socialize with people or for broaden your exposure for better career. So, everything in moderation is here. I wouldn't follow rigidly sort of the fixed percentage on anything unless it's justified and tailored to you. Second point about debt ratio. This is an interesting point because if you observe the people who are from, different backgrounds, they usually have a lot of different preferences. You've got some of the buy-to-let landlord who try to leverage their money 10 times. So they can, have a leverage position for maximum capital gain. And you have the other extreme who wants to pay off the mortgage on their home ASAP, so they feel they completely own the roof above their head. We would say, as financial advisor, again, your debt ratio should be modest and manageable. 20 to 30% is very reasonable. 50% is acceptable. Over 100% is highly leveraged. And having zero debt is not a great thing. It's just inefficient, especially given how low the interest rate is at the moment. Liquidity ratio, the third vital I would be talking about, is super important to the entrepreneurs here. Because your wealth is mostly sitting in the company you are building, is illiquid, and that's the majority. It's a concentrated position by default. So it's not a good idea for you to put all the spare cash into something else that's illiquid, be it angel investing or real estate, anything that cannot be liquidated within 5 days is illiquid. And you have, I have seen again and again liquidity crunch in my clients' personal wealth. I had a client crying in my office 3 times because she technically owns 20 million, that's her net worth, but she only has 2 million portfolio invested, and we were just, struggling to achieve a certain of income out of that portfolio to support her lifestyle. So again, liquidity ratio is super important. Doesn't matter what your nominal net worth is. And the fourth point is timeline to retire, financial freedom, whatever way you want to define it. Some people say, okay, I don't want to retire. I would like to work until the moment, until I drop dead. Good for you. As long as you feel you're working for what you love, not working for money. Wouldn't you love to get to financial freedom and then just working for free for what you love, such as being a volunteer or something like that? So we would say this is, narrowly defined more about how much you should be doing what you are doing now to get you to a financially comfortable position. And then you're free to pursue whatever you want without financial considerations.
Qiaojia, where I can find out more about these ratios? Are you going to share them after the webinar?
Well, after the webinar, we will share a Notion list of some reading materials. But for these 4 ratios, we are building into our first draft of financial, automated financial planning. So you don't have to do all the calculations yourself. And, once you have created your profile with Rosecut, we will let you know once we launch it. But we will be the first one to launch all this, technical tools that's super easy for you to use. Just give us a little bit more time.
I look forward to it because I already a client. Yeah.
You will receive that as our client. Don't worry, Yana. So I want to quickly, mention what we could offer you based on what I have just talked through, right? So if you create your profile with Rosecut platform and answer the questions we put down there, there's a reason why we ask those questions, like your financial GP. We can't have a health check, therefore we would ask you questions and you can try to answer them as completely as possible so we can show you. This is a personal wealth balance sheet. This shows what your real net worth is and with the real-time market value. So we will show you what your investable assets, what your liabilities, and notice home is separated from your investable assets. And we would say what is the emergency fund that you should put aside based on our knowledge of your circumstances. Lots of this you can play around and set up your own parameters. And the next part is your lifetime cash flow projection. And this is usually the surprise page. People would actually call us to say, really? Starting from 170,000 today, are you telling me I'll retire with 5 million? The answer is yes, likely, if you follow what we are suggesting to do to save consistently and to invest consistently. And based on the past market data, and this is where you are likely end up with. We can't guarantee that because it's mostly need to the future, you know, financial market, how they perform as such. But this is the best data we've got in the past, and we use that to project your financial future. And again, this is super easy to use for you to project in your expected money that you are going to receive, such a pay rise, a gift from your parents, second income, or when you're expecting a baby, like our co-founder, you have to set aside education fund, or you know, you want to buy a property in 5 years' time. All this you can add into the tool, and it will make the graph move around, and you can iterate it 100 times until you're happy with the result. This will give you the percentage that you should be saving every month and how much you should be expecting when you retire or achieve financial freedom. And we show you a real-time display of distribution of your assets. So the static basket is typically your home and your investment basket, and then there's your cash reserve. So I just, you know, wanted to quickly show you the screenshots here, but feel free to find out afterwards by playing around on our web app or iOS app and Android app. And once you have built your personal financial plan, you actually need to implement that. And typically, when you implement your financial plan, it involves investing into financial market and potentially some other things. So, you know, Yana's friends ask about how do we actually invest our cash, and we decided to give 2 examples here for illustration purpose. Now, we decided to call them 0.5 carat portfolio and 5 carat portfolio as a play on the Rosecut name. In case you don't know, Rosecut means ancient way of handcrafting the diamond. Every diamond is unique. This is our way of saying bespoke service for the unique you. Unlike the diamond, the 0.5 carat portfolio will actually grow if you look after it. So the first example, if you manage to put aside £1,000 and you don't expect to use this cash for any time soon in next 3, 5 or even longer, 3, 5 years or even longer, and this is what you could do on a DIY basis. Important note, we would just say this is a proposed scenario, not actually financial advice. We would say keep it super simple. Choose one global equity ETF and one short-dated corporate bond. And just buy and hold and leave it there. Don't look at it. Give it time. It will grow. There are plenty of online trading apps there, but our suggestion is do not trade. Picking between Tesla versus Google will really not do you any good. There is so much work that needs to go into the research of each individual companies, and you have to worry about the single company risk. So try not to stock pick, try not trade. Trading only contributes commission to the trading platform. And you'll be asking, what about the free trading platforms? Well, they still have to make a living somehow, right? So their revenue comes from the spread. The spread is defined as a buy and sell price that you pay. Every single trade, you lose a tiny slice of your capital. So this is our recommendation to someone who has £1,000 to invest, and just do that. Don't forget to top up every month. So eventually you get to 50,000 where you can knock on the door, Rosecut, and we will invest it for you. So second case study is if you have £1,000, and this is 6 figures when people realize, actually, I need professional help. I don't know what I'm doing with that. And we would have a global diversified, very liquid portfolio catered to your needs. It can be invested into GBP or US dollars and has exposure across different sectors, industries, and asset classes. So our past 2019 return for medium risk portfolio was 16%. and we are beating the private banking benchmark ARC index by more than 2% so far. So we are very happy with the investment return we have generated for our clients. But again, this is for illustration. It's illustration only. For each individual client, we will give specific financial advice. So final thing before we open up to Q&As is that the best thing is a crystal ball to show your financial future. We believe the second best is Rosecut. We will lay out all the important questions to you, understand your plan, paying, and build a strategy for you and help you to get there. That's all the presentation part. Yana, do you have questions or?
No, I think we actually can move to the, I mean, the thing is, I mean, that you already mentioned, right, that after the webinar, it will be distributed, the list that you carefully selected with all the sources that people might need to learn more about personal finance, right?
Yes, I think for people who, you know, have different needs, and it's really important for them to realize they need to take individual bespoke advice rather than, you know, follow the experience of someone else, because someone else's experience may not apply. I understand that it's difficult to have access to the financial advisors before sometimes for the market, and this is why we built Rosecut.
Mm-hmm. Wonderful.
So
move to the Q&A session.
Yeah, I think just looking at the open Q&As, so the first one is that what should be the size of emergency fund as a percentage of total assets? I wouldn't say it should be as a percentage of total assets. It should be multiples of your monthly spending. So, you know, I have clients who spend 60,000 a year, or some spend $500,000 a year. For the people who spend $500,000 a year, probably you need at least, you know, $250,000 as emergency fund. Regardless of, both of them could have the same sort of net worth. The next question from Siming is to say that what kind of assets can be considered as effective diversifiers today, with core government bond yields being so low while gold price surging record high? Good question. Now, gold price surging record high is one point. By the way, it doesn't mean you should be rushing to buy gold right now. This is another thing, right? Like, knowing what to buy is based on a lot of judgment, but what you actually can buy in gold is another one. So I wouldn't suggest, you know, rushing into the gold at the moment. However, when the core government bond yield is so low, I agree. So, you know, gilt, the UK government bond, a 10-year gilt stands at 0.25%. So there's really no point for you know, most people to spend a lot of cash, allocate a lot of cash into that. So diversifier means that, you know, you have emerging market allocations, such as, you know, the BRICS versus developed market allocations. You have different industries, you know, such as tech versus material, industrial. You have bonds or equities, or sometimes alternatives. For example, we will have the next seminar about, you know, bread and butter investing into financial market versus passion investing into wine or arts later on. So, you know, diversifier doesn't mean the diversifier needs to, investing to diversifier doesn't mean you need to achieve the highest return from that. It's really about, you know, having the collective sort of risk management out of all the money you invest. If you have, you know, a lot of cash, we would really welcome a conversation. If you just want to start out and try something on your own, as said, one single city ETF, a global ETF tracker, and one single short-dated bond. The long-dated bond will be impacted much more by the inflation rate and interest rate. that's all you need to have. I hope that's actually a very easy to do solution rather than trying to pick stocks. The next point is that the Welsh balance sheet looks very interesting. How do you ensure it shows real-time inflation? I currently store asset values in a spreadsheet and update it monthly. Do you use open banking or similar to do this? Bingo. We are in the process of using open banking to provide you real-time information on your Welsh balance sheet. Again, it's under construction. We'll get there very soon. It's very interesting. You said that you store asset values in spreadsheet and update it monthly. Well, most people don't update it monthly, so kudos to you that you actually do that. And even that, sometimes people put pension as a single entry next to their general investment. Well, you could be having equities in both accounts. So our personal wealth balance sheet is professionally done, listing the right assets into the right category and give you, sort of, let's say, the textbook definition of your net worth. The next one from Asif, and the next one from Asif, how do we navigate our way through the current volatility in the market? Yes, so as we said, the market will go through a phase where it's super volatile, like the past March, or in the 2 years before, super benign, right? So this is just part of how the portfolio manager manages their investment. Without going into too much technical details, basically there is a way to look at the various indicators in the market and decide, whether we should be, risk on, meaning, buying more riskier stuff, or risk off. Every portfolio manager would have their own thesis of how they want to approach this, but they're all governed by your risk level. Risk is, a budget that the portfolio manager gets to spend, rather than trying to achieve the highest potential return. You look at, how much risk you could afford, and based on that budget, our portfolio manager will decide to allocate into investments that achieve you the highest potential return for this risk level. So they look at, the systematic risk, such as, the whole market or individual investment risk, and then do overall risk management to make it happen. What is the minimum amount required for opening a Rosecut account? Everyone is welcome to use a Rosecut platform. It's for free, and it's completely there for you to use. Because we firmly believe good financial education or help with financial plan, it should be almost made like a public goods, like the GP system. So we built a Rosecut platform for everyone. Now, you can be a free user for the foreseeable future. Now, if you want us to look after your money for you, then the minimum account opening amount is £50,000 or equivalent. Why that number? It's arbitrary. This is how we think it will move the needle for your personal life. By the way, technology is beautiful. It can allow you to invest £1 and split it over 10 instruments. Everyone can technically invest, but is investing £1 or £10 going to move the needle for your financial future? We don't think so. So this is why we set a 50,000 minimum. And if you use the Rosecut platform to save up to that amount, that would be super helpful, for you to achieve your financial freedom in the future as well. So the next one, how do we differentiate from other digital wealth advisors are in the market? We are not a digital wealth advisor. If you think about what a private bank does, the 90% is in the upfront strategy part. The last 10% is in the portfolio management part. Typically, the wealth advisors in the market that we have seen, the likes of Nutmeg or Money Farm or Wealthsimple, they do the last 10%. They tell you, they don't give you financial advice. You are answering the questions, the minimum required by the regulation, so you can put yourself into a portfolio they manage. Of course, there is a lot of benefit of this, but we believe that what's more important is the strategy. That is, understanding your personal circumstances, understanding where you want to go, understand your wishes and constraints, and build you the overall wealth balance sheet, so you know where you are, and give you the lifetime cash flow projection, so you know where you are heading towards. So this is a conscious understanding for you to make investment decisions, and this needs to happen beforehand. And I can tell you, 90% of my time was spent with private banking clients on this. The portfolio management was just the last 10% of implementation. So the next one asking, will we provide investment advice or it will help to invest? Yes, we do both. So we will give you investment advice, and we will also help you to invest. Currently, our investment is co-built by ourselves and Dolphin Financial. So, the discretionary mandate was done by both sides under their supervision. So we will be able to implement the investment for you as well once you proceed. So the next question saying that mention the use of AI in your approach. How much client data would you say would be sufficient for machine learning to be accurate and meaningful? Very good question. So in terms of the client data, first of all, it's feature rich. So for machine learning, there are different types of machine learnings, and I'm not probably the best one to talk about this. Perhaps my CTO. But the essence is that for financial planning, there is limited outcomes that you can reach. You either succeed in getting to where you are, or you won't succeed. So we will look at all the different data and then trying to build the best path, optimal path to get to where you are. And by the way, there's also a lot of regulatory requirements around us as well. The next one is human interaction is there in the investment decisions. Are you close to Nutmeg or Langston? We are neither, as mentioned just then. Nutmeg is a platform for you to answer a few questions, then you put yourself into a portfolio. They don't technically give financial advice to everyone that is investing through them. And Langston is a DIY platform. You open an account with Langston and you take your pick out of 3,000 funds. And let me ask you, which one are you going to pick based on what? So for us, we would not ask you to DIY. If you invest with Rosecut, we would say, this is your risk level based on your circumstances and future wishes. And this is what we recommend is a single portfolio you should be investing in. And this is basically the typical private banking service that we give you the recommendation, which is like, your doctor, your GP give you the prescription. So
I just have a quick comment on that, because I also remember the time when I opened up the account with HL, but then I was unable to find out because I have a lot of funds available, but I have no idea which are the funds I need to pick up. And on top of it, you really need to follow all the time precisely what's happening on the markets. And unfortunately, I just don't have time because I have my full-time job.
Exactly. Managing one's, investment is such a, consistent thing that you have to always spend time, research to follow it up, right? So it's quite difficult. And people pay money to private tutors to teach their kids, or pay money for, driving instructors, or pay their nanny to look after their babies. And investing is so much more technical and more complex than those jobs, right? Like even those jobs are super important as well. Why would you want to risk, DIY itself and risking losing a lot of money, at substantial downside? So my point would be hire a professional if you can to do that. I think there are the
last question, right? Because we need to wrap up, I think.
Yeah, we need to wrap up. I think the last one, when we should save and when should we invest? The answer is yesterday. If you didn't do that yesterday, perhaps today. It's a nice way to close this webinar because your financial future is starting from now. So you should have saved yesterday. If not, no matter, starting today, start building your budget and your personal wealth plan and investing tomorrow.
Yeah, I totally agree, because sometimes, it just takes so much time to open up, for example, to make this decision to start investing with a platform, but then in this couple of months that you're kind of not sure about whether you need to go ahead and start investing, you're actually losing money, right? Because of this, you can actually earn already some kind of percentages on this money that you could have put into, investments.
Yes, exactly. So I think one of the things I would say is people's inertia. They put the money aside. They think, I'm going to do something about it. I'm going to buy a flat in 2 years' time. Well, there has been many 2 years that has passed and you haven't bought the flat. So, do something about it. Otherwise, it is steadily, surely losing value every single day. So this would be my closing words. And thanks for everyone who's decided to spend an hour with us to go through this.
Yes, yeah. Thank you so much, Qiaojia. It was very interesting, the webinar. Even for me also, I know a lot of things already about investing my private money. But then just the closing word is we will have the PDF document or the Notion distributed with all the useful sources where you can learn and read more about personal wealth and personal finance.
Great. Thank you, Yana, so much for co-hosting this with me and frankly, putting this idea in motion. And we will circulate the Notion list after this.
Okay. Thank you, everyone, for joining. Have a great.
Thank you, everyone.
Bye-bye.
Bye now.